Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
When I met you in the summer.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome back to another episode of the Equity Mates Summer Series. This is a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Continue to be excited for this whole series as we go and speak to some of the best financial advisors, fund managers, and just investment professionals, I guess, the catch-all term.
Yep.
And we understand the lessons they've learned over their careers and their lifetimes of investing. We understand how they would start today, and we really unpack those lessons that can help us set up 2025 to be our best financial year yet.
Yeah. And today we have star stock picker Rikki Bannan joining us in the studio. She's Executive Director of Small Caps at IFM Investors, has been there since 2015. They are a leading global institution investment manager. They're actually investing on behalf of our super funds.
Amongst many other people that allocate money to them, yes. And I think for people who have heard Rikki on the Equity Mates podcast before or have seen Rikki pitch at the Sohn Hearts and Minds conference, you mentioned she's a star stock picker. I'm not sure that's exactly how she would describe herself.
She wouldn't, I know for sure.
That is the reputation she seems to be building. She pitched Telix at the Sohn Hearts and Minds conference last year. That's up. It's more than doubled since she pitched it. I think doubled and a bit more. On Equity Mates last year, she pitched Clarity Pharmaceuticals. That's up more than 600% since she spoke about it on the podcast. Unfortunately, neither you or I bought it.
No.
And then this year at the Sohn Hearts and Minds conference, it only happened about a month ago, so TBC how it goes. She pitched Corporate Travel Management, a beaten down travel stock that she thinks is poised for a rebound. So rest assured, we asked her in this interview for
the next Telix.
For the next stock pick. But look, I think what I really found interesting in this conversation is Rikki she's built a bit of a reputation for investing in biotechs, a riskier part of the market. And we really tried to understand how she approaches those risky picks from a portfolio construction point of view. How do you try and capture that upside, but also manage that risk? And I think for Aussie investors who love a mining specky, and a mining explorer that may or may not strike gold, literally, in some cases, or, a biotech that's going through their stage 1, stage 2, stage 3 clinical trials, those options where there's kind of a binary outcome. How do you fit them into a portfolio? And so we unpack that with Rikki in today's conversation.
She literally talks about her little budget allocation that she's allowed for it.
Her risk sleeve.
A lot of greater actionable insights for portfolio construction from Rikki.
And you're going to have to wait until the very last question to get the stock pick, unfortunately.
Now, before we jump into it, we should also say a huge thank you to Viola Private Wealth and the team for supporting this series. Viola Private Wealth combined decades of experience with a dynamic approach to investment management. Managing over $2.5 billion in assets, they help high net worth individuals and families navigate an ever-evolving financial landscape with confidence. Now, you've also probably heard Charlie plenty of time helping the Equity Mates community through Pimp My Portfolio. If you have just joined the community, search his name in our feed and plenty of his stuff will come up.
Yeah, so for more information, head to violaprivatewealth.com.au. But with that said, let's get to our conversation with Rikki Bannan.
Well, Rikki, welcome to Equity Mates.
Thank you.
So, investing is a lifelong journey, something that I don't think anyone ever masters, but it's something that we're always trying to get better at, and there's always something to learn. So with that in mind, what are you working on right now?
Trying to find the next Telix.
Nice.
Aren't we all?
Yeah, my sole pitch for this year. I would love to say, I spend a week, going down a deep dive into a specific stock or sector. That would be great. But there's a lot of short-term noise that you sort of need to sometimes pay attention to in the job, and lots of meetings with companies. So, is there one thing that I'm sort of specifically working on right now? To pinpoint an interest in small caps, because it's, small caps is such a diverse group of stocks, even within, a specific sector. These stocks aren't homogenous. So I would say, it's probably hard to answer that and say I'm working on one particular thing.
Well, if we zoom out a little bit and just like in the small cap world and the conversations you're happening with other managers and company leaders, like, are there any trends or shifts or interesting things that you're seeing emerge that you can, share with us?
Yeah, sure. I think this has probably been true for the last 2 years. It's all very macro focused still. Obviously, the Fed started cutting rates. Jury's still out, but, I think everyone's thinking a soft landing could potentially be a possibility. All eyes are on the RBA when we start seeing rate cuts here. So I think everyone's very much focused on that. So anything with leverage to falling interest rates, whether that's like long duration stocks like tech stocks or REITs or, companies with geared balance sheets, consumer stocks, anything cyclical like that. I think that's all very much in focus. When is the right time to sort of be jumping back in with wherever you view on interest rates, how quickly they're going to come down. So from a macro perspective, I think, this next 12 months is really going to be where the rubber hits the road on the macro. And it's just been something that everyone's been very, very focused on in the last 2 years. I suppose from a more interesting thematic perspective, AI is clearly very topical. The reporting season in August, I think every single company had at least 1 or 2 slides dedicated to AI, how it was going to transform their business. So, look, I think there's certainly been a lot of hype. A lot of these stocks, here and overseas, valuations have been quite stretched. Everything's sort of running ahead of actually seeing sort of, real sort of tangible benefits coming through. So look, in the fullness of time, I do think there's a real opportunity for AI to transform a number of sectors and companies. But in the short to medium term, it's probably a bit more nuanced as to where, the benefits actually are. So it's just probably something to watch and see. And, the obvious plays have been your data center operators like NextDC, Macquarie Technology, those developing DCs like a Goodman Group, a bunch of other tech names as well that have all sort of run on the AI thematic. Healthcare, I think, is a really interesting sector. It's very topical there. The diagnostic imaging stocks, there's a couple of different ways how AI, I think, is going to, over the long term, transform how their businesses operate, just from a patient perspective, but also like the back end, the more boring like workflow processes side of things. I think there's some real efficiencies that can come through there. One that springs to mind that, again, it's kind of random and you wouldn't necessarily think that it's been a beneficiary of AI, but it's just one example that in the last reporting season, rather than just talking about it in big, broad terms, you actually saw a tangible benefit, and that was Temple & Webster.
Oh, yeah. Where they've got their descriptions updated or something.
The customer service, they've taken, I think it was $4 million annualised cost saving by having 40% of their customer service interactions handled by AI as opposed to an actual person, which, again, it's one small example, but, they're one company that can actually point to, a real genuine sort of saving, and then more broadly and longer term for them, it's about getting conversion higher through using AI. But anyway, look, everyone's talking about it, and we'll wait to see where you can actually see the real benefits come through.
Yeah, well, let's hold on AI, because I think one thing we're really fascinated about when we speak to expert investors is how you both keep on top of the day-to-day noise of markets, but then also like develop that domain level expertise that you need to make investment decisions around, companies in pretty disparate fields. Your Sohn pick last year was Telix Pharmaceuticals, and you also came on the podcast and spoke about Clarity Pharmaceuticals. And then, we're also talking about, you just mentioned Temple & Webster there and the AI thematic and stuff like that. How do you go about developing the level of knowledge you need to then be confident in the investment decisions you're making?
I mean, it's really just down to reading as much as you can from people much smarter than I am on these topics and speaking to people. That's it at the end of the day. And, I suppose the benefit of working for, a global investment firm, with institutional backing, like you do get access to a lot of research, a lot of high quality research, and a lot of key opinion leaders in the healthcare space, for example. Like that's been a big part of my journey, understanding the radiopharmaceutical space. Just, having calls and listening to some key opinion leaders that are actually working on these clinical trials and are deep in the field of radiopharmaceuticals. So that's one example. So it's really just reading as much as possible and speaking to experts in the field where you can and building a network.
What was it that got you really interested in investing, or kind of was the spark to where you are today?
So I think it was probably my dad. He's been in equity markets his whole life, and I joke that, he must have been reading his research reports to me as bedtime stories or something. But I remember doing work experience with him when I was, my goodness, like in year 9 or something like that. And so I suppose that was probably my first exposure to equity markets and what a career would look like. I did always gravitate towards subjects like business studies and economics when I was at school, but actually it probably wasn't initially what I thought I would do. I do remember Dad always saying that, it was the most intellectually stimulating, job you could have. And it was the most fascinating job you could have. He just loves markets. And, I wanted to be an international human rights lawyer, but, broking is just as noble as that. So that's fine. But honestly, all jokes aside, I think I have found it really interesting. And it's been a real journey and learning every step of the way. And like still today, that's true. So
Nice.
When you think back to the early days of starting out, I guess, in the industry, but also just managing your own personal money and learning to invest yourself, were there any major lessons that sort of left a mark and have stuck with you today?
Yes, definitely. I think when I first started in broking as a research analyst and being the primary analyst on a stock, I think my first real hard lesson was don't get too caught up in the momentum. I think there can be a tendency, particularly in small caps, to want to chase a stock. If it's going well, then it just has that kind of that force behind it, and that can be. It can be tricky, and these things rarely go on a straight line. So I think, that early lesson was don't get caught up in the momentum. Take a strong view of what the stock is actually worth. And at the end of the day, equity markets, there's volatility, so you can be patient. And if you have a view of what the stock is worth, there's bound to be a pullback and an opportunity to take a stronger view and to buy it. That's probably the first one. I guess also, maintaining a healthy level of skepticism and doing your own analysis. I think, don't believe everything management tell you, because it's surprising how little visibility some management teams have, even about their own business. So I think that was probably an early lesson as well, like just second guess everything and back things up and, with your own analysis. I think that would be, you can't just rely on what you're being told. And then I guess just be really clear on your thesis. Why do you own the stock? And don't be afraid to go against the masses. I think when I started in funds management, you never forget your first downgrade that you cop. And mine was Lavisa back in the day. So it had IPO'd semi-recently, I think. And it had a downgrade. I think there was, this was back before it was sort of a global retailer. I think they ordered the wrong fascinators for Melbourne Cup, or too many fascinators or something like that, Fascinator Gate. I still joke with the CFO about that one. And the stock was absolutely smashed. It was down 40% or something. And then it was probably dead money for 6 months. Like no one wanted to touch it. But I did have conviction over the business model. I thought it was a really good retailer. I thought there was a really compelling global store rollout opportunity there. It's a high quality retailer. It's got a fantastic return on capital. It's got very high gross margins, vertically integrated. There's a lot to like. I stuck it out and, bought more and, for 6 months or so or more probably, just the stock didn't really do anything, but I sort of stuck to the thesis and then, all know sort of where it's trading today. So, but that was early on in my career in funds management. So that was tough going, sort of sticking it out when everyone else sort of seemed to abandon it for a period of time.
So let's fast forward to today. Over that over your journey in markets, how would you define your personal investing philosophy?
So I guess my philosophy would be that over the long term, the market's going to price a stock fairly, but, so it's share price reflecting fundamental value. But in the short term and over that journey, I think there's going to be points where there's a dislocation between what is market value, what the market's paying for a stock and what it's worth. And that might be, the macro, it might be that, non-fundamental factors at play. And, I suppose what you're trying to work out is what the intrinsic value of a stock is. And taking advantage of those points in time where a stock is undervalued.
And was that always your philosophy? You mentioned getting read, equity research from your dad in the crib. Was you also reading, Buffett and the like?
Security analysis.
Or has that philosophy developed and changed over time?
My dad is a true value investor, so I wouldn't describe myself as a true value. Like, valuation is important, but we do actually see stocks very differently. Have many healthy debates over the dinner table still. I don't think my philosophy's changed. I think, what does change and evolve over time, though, is your process. And that's just part of, I suppose, the scars and the learnings along the way. So I don't think the philosophy has changed as much as, I guess, your approach to maybe analysis or how you think about stocks. And that's just going to be a constant evolution, I think.
Well, how would you define your process, like as opposed to philosophy? Like, how do you actually approach
it just is breaking it down into something really simple, like just understanding what you're investing in, first of all. What is the business? What sector is it operating in? What's its position in that sector? The macro is important, but that's going to sort of dictate maybe timing of when you invest, rather than like, is this something that I want to own for the next however many years? But, I suppose more importantly, structural factors. Are there any structural drivers that impact the company? Understanding its strategy. How does it plan to grow? Do you back management to execute that strategy? How are they going to fund it? It's literally just sort of going through step by step and thinking about those simple building blocks. There's a lot of research, there's reading, there's, you build a model to try and work out, what the company's worth. You meet with management, you meet with competitors, suppliers, customers. You're trying to just build that holistic view of the company and its position in the industry that it operates in. So that's really the process.
What are some of the key characteristics of companies you've invested in that have been your big winners?
Genuine structural growth stories. Companies that can grow despite the prevailing macro is probably, what we sort of gravitate towards. You want to see a sustainable competitive advantage. We're very much focused on quality of management, because at the smaller end, you're dealing with a lot of, founder-led businesses, and management are, they are the strategy. The CEO could be literally the sole driver of the strategy and how it's being executed. So very much big focus on the quality of management, looking at cash generation in small caps, like cash and balance sheet is absolutely key. What does the cash generation of the business look like? Looking at management, actually, their alignment to shareholders. So again, that comes back to the whole founder. We've had a lot of founder-led businesses in the small cap space that have done incredibly well. I think I said before, it's probably not a great week for founders, but that aside, we do like strong alignment between management and shareholders. And, we're just focused on metrics like, return on equity, return on invested capital, look at free cash flow, those sorts of things.
Rikki, we're just going to take a quick break here to say thank you to Viola Private Wealth for supporting this series.
In a changing economy, adaptability and insight is essential. Viola Private Wealth offers fresh perspectives and bespoke strategies to help grow and protect wealth, ensuring security and peace of mind in uncertain times. For more information, head to violaprivatewealth.com.au. Now, Rikki, you have quite a vaunted position amongst Equity Mates guests, because you first came on the podcast about a year ago, and you certainly you put your money where your mouth was in some ways, because you spoke about two stocks on the podcast, and then you spoke about one at Sown Hearts and Minds a little bit later. So you spoke about Clarity Pharmaceuticals on the podcast, which is up 578% in the past 12 months.
Nice. Hopefully everyone got long.
Well, we didn't get on. What do you got for us today?
You spoke about Telix, which is up 151% in the past 12 months. And then you spoke about Propel Funeral Services, up a measly 27% in the past 12 months.
Sorry.
I guess the small cap space is known for the opportunity to get these multi-baggers, and there's more risk, but there's more return potential. There's they can grow sort of GDP plus in many cases, but that also leads to like a portfolio construction and investment process question around like, when do you cut your losses? How do you manage position sizing and stuff like that? And obviously it's slightly different for retail investors as it is for yourself, but just generally, how do you think about letting your winners run or taking profits? And do you have any like rules that you think we could take from your process and think about for our own?
Yeah, sure. So, I mean, there's always a strong inclination to let it run, and momentum is such a powerful thing in when it comes to investing, particularly in small caps. You do need to have a strong view of what a stock is worth. It's never just going to go in a straight line. I mean, sometimes that does happen, but rarely does that happen. So if we were initiating a position in the fund, how much of a stock we buy would be a function of its size and liquidity, our conviction, how much valuation upside is there. So that'll dictate sort of where you sort of start from a position perspective. And then, you might just sort of harvest gains on the way up to maintain that, or you might let it get to, bigger and then sort of sell down. But so it's sort of, it's probably it depends on the stock sort of answer. But, we are very much conscious of, what a stock is worth. You don't want to be sitting there just holding it because, oh God, gosh, it feels good. It just keeps going up.
Gosh, I'm like 577%. We're using Clarity as an example. Like, how has that been over the last 12 months? Have you been?
Yeah, so I mean, and by its very nature, so that is a clinical stage biotech, and your outcomes there are pretty binary. A clinical trial can go well or it can not go well. When they get to the point of submitting to, say, the FDA for regulatory approval, that it can go either way. These things happen. So by that very nature, that's a much smaller, I think I would have said this last year, that's, a smaller position in my fund than, say, Propel, which, is a very stable sort of defensive business. Now, sure, that would have been nice if I had as much of Clarity in my portfolio as Propel, but that's got a fiduciary duty to clients, and that's just not sort of a wise way to manage money. So when a stock like Clarity does go up by that much, you are sort of taking some profits on the way, but maintaining a position still if you continue to see the upside.
So, Rikki, if you had to set up a portfolio for a retail investor for the next 30 years, doesn't have to be position specific as much as we'd like you to give us what small caps are going to be the winners for the next 30 years. How would you think about investing, maybe from a principles point of view, portfolio construction, those sorts of things? How would you think about setting up a portfolio?
Yeah, well, I mean, 30 years is a really long time. Okay, so I guess you just want it to be, and this is, I suppose, how I would be doing it if this was, me personally. Yeah. You don't want to be overly concentrated, I don't think, in any sort of particular segment or asset class. I think you want to have, for a period like that, capital preservation is key. So more heavily weighted to something that's like lower risk, lower return, but lower risk. I suppose, the way I think about investing in biotech, like in my fund, I have a budget for those kinds of stocks, as does my co-PM who's responsible for investing in resources. He's got some core holdings, and then he's got, I suppose, a budget for things down the riskier end of the curve, the spicier end. Nice. So that's probably, I think that's probably just a good way to think about a portfolio, capital preservation, but then, a small allocation
like
to
a core satellite.
Yeah, sort of exactly right. Yeah.
Nice.
Let's forget the 30-year lockup, and just in terms of this budget, I don't mind that. It kind of gives us a permission structure to take some riskier bets. So, how much of the portfolio do you think, or if you can share this, do you think is the riskier budget, and then how much is the more like?
Oh, I mean, quite small. Yeah. But, we're an institutional investor, so it depends on what your risk appetite is. But, just remember for those investments at the spicier end of the market, your biotechs or your, the specky resources, you've got to be happy to say goodbye to that money potentially. Yeah. You know what I mean? So I suppose it's just going in with your eyes wide open, understanding what you're investing in.
Yeah. Yeah. Maybe I'll give myself a little budget for some more crypto.
Good luck.
If there was one lesson that you could teach every young investor that you wish everyone, learn at school or learn from their parents, what would that one lesson be?
Understand what you're investing in. I feel like I've already said that, but yeah, understand what you're investing in and be really clear on why you own the stock and what it's worth.
And then on the flip side, is there any conventional wisdom that you constantly hear repeated time and time again in industry that you think is just, that you shake your head at and go, this is just wrong, or it doesn't fit with the way I think about markets?
Yeah, I suppose something that you hear sometimes, and I think I don't know that I agree with that, is volatility equals risk. I don't really think that's true. I think, risk is the permanent loss of capital. Volatility, that's just part and parcel of equity markets, and that creates opportunity. Volatility, that's, a stock goes down, that could be your opportunity to buy a great business at a attractive valuation. So yeah, that's probably one that I hear from time to time that doesn't make a lot of sense.
Nice.
Love it.
We will be crucified by our audience if we don't ask, what's the next Clarity Pharmaceuticals? What are you looking at?
Well, I do have a biotech that I like that I could share with you. That's PYC Therapeutics.
Okay.
They have RNA therapeutics, and they're going after rare monogenic diseases. And the reason why that's interesting, so for something like cancer, there are a number of, drivers behind that disease, and scientists can't quite work out all the reasons why someone may get cancer. You've got environmental factors, you've got hereditary factors coming into play. Rare monogenic diseases means that the disease is caused by one single genetic mutation. So to start with, it's easier to understand, to isolate that, and therefore to potentially come up with an effective treatment. So already you're increasing your chance of success. That's what they've got. Four assets currently in preclinical and clinical. It is fairly early stage. They're sort of phase 1 and preclinical. It is earlier than often I would be getting involved in a biotech, because the earlier stage you are, obviously the greater risk there is that you're not going to actually get a successful product. But a couple of these factors, including their approach, which is rare monogenic diseases, increases chance of success. They are going for, as I said, a couple of rare indications. That means you get high pricing when you eventually get approval, and they're disease-modifying drugs. It's not a cure. So they've got 2 blinding eye diseases. They've got polycystic kidney disease, and they've got a neurological disease as well. The treatment disease modifying, so a patient will be on that drug for the rest of their life. It's a super interesting company, and one that we've owned for a while, and it's there's a lot of exciting clinical data, I think, to come out over the next 12 to 18 months. I'll have human efficacy data across each of those 4 indications, and it's a space that's getting, RNA therapeutics is a space that's getting a lot more attention from big pharma. There's been some really big deals done in the last few months. So one to watch. Like all these biotechs, they do clinical trials are expensive, so they're going to need probably to raise more money along the journey, or they could potentially sign some sort of licensing deal. But yeah, funding is the key question mark over the next 12 months.
Yeah, we hadn't really heard a lot about radio diagnostics, and then you came on the podcast, and then it feels like we heard about it everywhere in the past 12 months. So hopefully it's the same with this RNA now. But it's just fascinating. Like I was just listening to you explain all that, and I was like, we could do like a monthly biotech update where it's just like, what's going on in this world?
So niche.
It's just yeah.
And it always surprises me how many are actually listed on the ASX.
Yeah.
I'm just like, a world that I don't even
it's fascinating.
have the knowledge to even figure out where to start. That's why we bring you.
That's why
in.
we get Rikki.
Well, again, I'm not an expert. I just try and speak to people that are smarter, that understand more of this than I do.
Well, I mean, that's the premise of this podcast. So we're right along there with you. But Rikki, look, we really do appreciate you taking the time and sharing your knowledge and lessons learned. And I'm sure we'll get you back on the podcast again. And so until next time, thanks for joining us.
Good to be back. Thanks.
So before we go, we want to say a massive thank you to Viola Private Wealth for supporting this series and helping us keep all of our content free here at Equity Mates. Managing wealth in a dynamic economy requires agility and insight. With Viola Private Wealth's experience, clients are equipped to not only endure market changes, but thrive in any environment. For more information, head to violaprivatewealth.com.au.
Now stay with us because our next episode is with someone who has over 44 years experience in markets, and it is none other than Jeff Wilson, a guy who has been advocating for us as retail investors for almost 5 decades.
Not us specifically.
Not us specifically, no.
But I think, look, Jeff Wilson is probably one of the most recognised names in funds management in Australia. So wherever you're listening to or watching this episode, make sure you're subscribed so you don't miss the next episode with Jeff Wilson.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.